This is a demonstration of problem 838B, accounting for uncollectible accounts using the aging of receivables method, notes receivable, and accrued interest revenue. The problem states relaxed recliner chairs completed the following selected transactions, and we are to record the transactions in the journal of relaxed recliner chairs. We'll omit explanations, and when we need to, we'll use a 365-day year to calculate the interest on these notes. So on July the 1st, the first transaction says we sold merchandise inventory to GoMart, receiving a $43,000 9-month 16% note, and we're to ignore cost of goods sold. So we're going to debit notes receivable, GoMart, for $43,000, and we're going to credit sales revenue for $43,000. Then on October 31st, it says we recorded cash sales for the period of $23,000. Again, ignore cost of goods sold. So we would debit cash, and again we would credit sales revenue for $23,000. On December 31st, it says we made an adjusting entry to accrue interest on the GoMart note. So the principal amount of the note was $43,000. The interest rate was 16%, and the note has been outstanding for 6 months since it was issued. So we multiplied 43,000 times 0.16 times 6 divided by 12, and we get $3,440 of interest. So we're going to debit interest receivable, and we're going to credit interest revenue, because that amount is an accrual, an adjusting entry that we make at the end of the year. They'll pay us the interest when the note matures. On December 31st, it also states that we made an adjusting entry to record bad debts expense based on an aging of accounts receivable. The aging schedule shows that $14,900 of accounts receivable will not be collected. Prior to the adjustment, the credit balance in allowance for bad debts is $10,700. So we know when we use the allowance method, we take into account the balance that's already in the allowance account when we make the adjusting entry for bad debts expense. We need a total of $14,900 in the allowance account. We have a $10,000 credit balance, so that means that we need an adjusting entry to increase the allowance account to $14,900. So to make that entry, we would debit bad debts expense for $4,200, the difference between the $14,900 and the balance of $10,700, and we would credit the allowance for bad debts for the same amount. Now we're in 2019, and on April 1st it states that we collected the maturity value of the GoMart note. So we need to first determine the amount of interest revenue from the end of December to the maturity date. So it's been 3 more months. So we take the principal amount of the note, $43,000, multiply it by the interest rate of 16%, and then we multiply it by 3 months divided by 12, because we've already recorded 6 months of the interest in the previous year. So that amount is $1,720. Then we need to calculate the amount that we are to receive from GoMart. We have the principal amount of $43,000. We have the interest receivable of $3,440, and now we have an additional $1,720 in interest. So the total amount that GoMart owes us is $48,160. So we will debit cash for that amount. And then we're going to credit first interest receivable for the $3,440 we accrued. And then we're going to credit interest revenue for the new amount of interest, $1,720. And then we're going to credit notes receivable, GoMart, for the principal amount, $43,000. The next entry on June 23rd says that we sold merchandise inventory to Allure Corporation, receiving a 60-day 6% note for $7,000, and to ignore cost of goods sold. So we're going to debit notes receivable, Allure Corporation, for $7,000, and we're going to credit sales revenue for the same amount. On August 22nd, it states that Allure Corporation dishonored its note at maturity, and the business converted the maturity value of the note to an accounts receivable. So first we need to determine how much interest was due on the note. The principal amount was $7,000. The interest rate was 6%. The note was a 60-day note, so we multiply 7,000 times 0.06 times 60 divided by 365 days, and we get $69 in interest. So when they dishonor the note, they want to make this now an accounts receivable. So we're going to debit accounts receivable, Allure Corporation, for the principal and the interest. We're still going to record the interest revenue of $69, and we're also going to credit that note, notes receivable, Allure Corporation, for the principal amount. Okay, and then on November 16th, it says that we loaned $20,000 cash to Tinch Inc., receiving a 90-day 8% note. So we're going to debit notes receivable, Tinch Inc., for $20,000, and we're going to credit cash for $20,000. Then it states on December 5th that Allure Corporation paid the account in full. So now we're going to debit cash for $7,069, and we're going to credit that accounts receivable that we set up for Allure Corporation for $7,069. Then on December 31st, it states that we accrued the interest on the Tinch Inc. note. So first we need to figure out how much interest we need to accrue. It's a $20,000 note. The interest rate was 8%. We're at December 31st. The note was issued on November the 16th, so the note has been outstanding for 45 days. All December plus 15 days in November. So we're going to take $20,000 times 0.08 times 45 divided by 365, and we get $197 in interest. So we're going to debit interest receivable for $197, and we're going to credit interest revenue for $197. And that is the conclusion of the demonstration for problem 838B.